Today we're talking about one of the most talked about automation companies in the stock market right now, Symbotic. If you've been watching trends in robotics, AI, or warehouse automation, you've probably seen this name come up again and again. And there's a good reason for that. Symbotic is a company that builds highly advanced robotic systems designed to automate warehouse operations from end to end. Their technology uses AI, computer vision, and fleets of autonomous robots that move at high speed to sort, store, and retrieve inventory with extreme accuracy. In simple terms, they're trying to reinvent how major retailers run their distribution centers. So why is the stock getting so much hype? First, Symbotic has a massive long-term partnership with one of the biggest retailers in the world, Walmart. Their systems are being rolled out nationwide, and this gives Symbotic a huge, stable pipeline of revenue. Second, AI and automation are two of the fastest-growing themes in the market, and Symbotic sits right at the intersection of both. And finally, investors see Symbotic as a potential leader in a market that could be worth tens of billions as more companies automate their logistics. Symbotic just delivered another high-momentum quarter, and the numbers once again show why this company is becoming one of the most watched names in automation and AI-driven logistics. This quarter, Symbotic reported $618 million in revenue, a solid 10% increase from last year. For the full year, revenue grew 26%, proving demand for automation isn't slowing down, it's speeding up. The company also ended the quarter with over $1.2 billion in cash, giving them massive firepower to continue innovating and expanding. Operationally, Symbotic is on a tear. They now have 48 systems live at customer sites, almost double what they had 1 year ago. 6 new systems went live this quarter alone, and they kicked off 10 new deployments, including new Greenbox sites and their first ever entrance into the healthcare world with Medline. Every time a new system goes live, recurring software and service revenue instantly gets stronger, and this quarter made that crystal clear. Software revenue jumped 57% year over year, and operations services revenue climbed 21%. Backlog, which represents future contracted revenue, remains gigantic at $22.5 billion. That's the kind of number you see from companies dominating their category. The slight increase this quarter came from pricing improvements and the addition of Medline, partly offset by the revenue recognized during the period. And the even bigger story behind the scenes is efficiency. Symbotic continues to speed up installations. For their largest customer, the company cut installation to acceptance time by roughly 3 months. That directly accelerates revenue, profit, and cash flow, and it shows the tech is maturing fast. Symbotic's adjusted EBITDA, which removes interest, taxes, depreciation, and unusual charges to show the true underlying profitability, came in at $49 million this quarter, up from $42 million a year ago and right at the top of management's forecast. System-level margins improved again thanks to tight cost control, stronger execution, and their new next-generation storage design that packs in more density and installs faster. So, with growth, better margins, and strong underlying profit, why did Symbotic report a loss of $19 million on the bottom line this quarter? Here's the truth. The loss wasn't because the business weakened. It was because Symbotic is investing aggressively. First, stock-based compensation increased as the company attracts and keeps high-level engineering and AI talent. This is a non-cash expense that reduces reported earnings on paper. Second, restructuring costs connected to acquisitions and integration work pulled down the quarter's results. These aren't ongoing costs, they're one-off adjustments. And third, overall operating expenses rose because Symbotic is pouring more money into product development, next-gen robotics, AI-driven software, and stronger customer support. These investments lower earnings today but expand the company's long-term power in the market. Now let's look at the outlook. For the first quarter of fiscal 2026, Symbotic expects revenue of $610 million to $630 million. That's right in line with this quarter, setting up a much stronger ramp later in the year as more next-gen storage systems come online. They're also projecting adjusted EBITDA between $49 and $53 million for the quarter, showing that profitability continues to move in the right direction even while the company is investing aggressively. The big picture here is timing. The shift to the next-generation storage structure means steadier revenue early in the year, followed by a sharp acceleration in the second half as deployments scale and margins expand. And now here's where things get really exciting. Symbotic is officially stepping into the healthcare world. This could become one of the biggest expansion opportunities in the company's entire history. Their new partnership with Medline is Symbotic's first move into a massive vertical with huge automation potential. In the US alone, there are more than 500 healthcare distribution centers covering over 76 million square feet. And in healthcare, accuracy, speed, and flawless reliability aren't optional, they're mandatory. That's exactly where Symbotic's robotic systems shine. Medline is starting with just one site as a proof of concept. But if Symbotic nails this rollout, and based on their track record, that's very likely this could easily turn into a multi-site expansion across a huge national footprint. The opportunity doesn't stop there. Symbotic can also upsell additional products, like micro-fulfillment for hospital receiving rooms and split case picking for specialized units. If Medline expands, Symbotic could quickly become a dominant automation partner in healthcare, just like they already are in retail. In short, Symbotic is growing fast, entering new markets, improving margins, and making massive upgrades to its technology. This quarter's reported loss was the result of heavy investment, not business weakness. The fundamentals are strong, the pipeline is huge, and the entry into healthcare opens the door to an entirely new multi-billion-dollar opportunity. So, to wrap it all up, Symbotic is sitting right in the center of one of the biggest economic shifts of our lifetime. Robotics and automation aren't just a trend anymore, they're becoming the backbone of how modern supply chains, retail, and now even healthcare will operate. Every major industry is looking for ways to move faster, cut costs, and eliminate errors. And Symbotic is one of the few companies offering a real, scalable solution. The stock looks expensive today on traditional valuation metrics, and the fact that shares soared after earnings doesn't make it look any cheaper. But companies leading a technological revolution almost never look cheap in the early stages. If Symbotic keeps executing, keeps improving margins, and actually unlocks the healthcare opportunity the way investors hope, the valuation today could end up looking completely reasonable in hindsight. Symbotic is not a stock for people looking for slow and steady. It's a high-growth, high-innovation company in a sector that's only getting bigger. And if they continue to deliver on everything we saw in this quarter, faster deployments, rising recurring revenue, expanding margins, and a massive backlog, this story has the potential to keep building for years. Thanks for watching. If you want more deep dives into AI, robotics, and the companies shaping the future economy, make sure to follow and stay tuned for the next video.